Well, hello everyone, and welcome to Insight with Beyond the Headlines and Political Tools. Today's debate is called the inflation bogeyman. COVID-19 has prompted the biggest central bank intervention and government spending programs in our lifetimes. The injection of money is seen as the only remedy to stave off economic disaster. But what will all that liquidity do in the long term? And are we about to unleash the monster of hyperinflation? I'm joined by David Smith, the economics editor of the Sunday Times, and the author of some of the best books, in my view, on UK and global economics. David, where are you joining us from?
I'm joining you from sunny southeast London.
Wonderful. Thank you, David. We also have Luka Gakic. Luka is an investment director at Ruffer, an investment management company with a slightly different approach to markets and finance. It's a strategy that has also left them relatively unscathed by the ongoing crisis. Luka, whereabouts are you?
I think we've got most of London covered. I'm in southwest London today.
Very good. Okay, we're just missing North London. Well, we're broadcasting here from the borderlands of Wales and England, so some way away from you. Luka, you've also got your own personal story, which is linked to inflation, which we'll come on to later. It's a fascinating story too. We'll aim to have questions and answers by about 1/2 the hour. And then at the end of the briefing, we'll have time to share our thoughts on what's being discussed. So please stay behind for that. Just raise your hand. There's a red hand button on the screen there when you want to talk, so I can come to you. Also, when it comes to questions, we can actually put your microphone on, and I'll give you some advance notice of that when you need to ask a question. There's a Q&A box at the bottom of the screen, so just type your questions in there. You're welcome to put your questions in as we go along. Our aim is to try and make this as accessible as possible. And I know some of you are very well versed in economics and monetary systems, and others, including me, less so, but we're going to try and make sense of this all. So David, I'd like to come to you straight away. Can you briefly outline the scale of intervention by governments and central banks? And then secondly, try and explain the impact of that in the medium term in, say, two or so years' time, and the possibility of inflation within that time period. David.
Yeah, hello everybody. It's a pleasure to be with you. I think the question of inflation is a particularly challenging one at the moment. And the reason I say that is because we've got two forces pulling against one another. The first force, of course, is that the COVID-19 is causing very deep downturns in every economy. So a global recession that is deeper than the recession of just over a decade ago in the financial crisis. And we're seeing the effects of that. And when one is talking about depression levels of economic activity, we tend to associate that not with inflation, but deflation of the kind we saw in the 1930s. And the second force, which is the one that you mentioned, is the unprecedented response of governments and of central banks, and the fact that the way that central banks have responded this time, I think with quantitative easing programs, QE programs, is very different from the way they responded in 2009. I think then it was a monetary policy response. They had reduced interest rates as low as they could possibly go, and there wasn't room to go any further. So when central banks had run out of room to cut interest rates, the next thing they could do was to provide a direct boost to the money supply through QE, and the aim of QE then was very much to offset the natural contraction in the money supply that was happening as a result of the damage to the banking system. This time, the response has been different, because I think it has been explicitly tied to the need for governments to fund themselves for these emergency programs intended to provide a bridge back to normality for economies that have been hard hit by lockdown. So it's explicitly linked to the need for governments to issue bonds, the need for the UK government to issue gilts to fund its budget deficit. So it's a very different thing, and it comes closer to what people fear, which is monetary financing or monetization of government debt. So it's a different category. I think we've moved into a different phase. I've got one or two slides just to illustrate the dilemma. If we can have the first one up, which just shows something we're experiencing at the moment, which is one of the effects of this deep downturn that we're seeing at the moment. Now, periods of high inflation in the past, one thinks of the 73, 74, the late 70s, have often been associated with a sharp rise in oil and commodity prices. As you can see here, the opposite is happening at the moment. For technical reasons, we had one of the US oil contracts, the West Texas Intermediate contract, going negative because people didn't want to pay to store the oil that they knew wasn't really going to be used in a lockdown economy. But more particularly, you can see, and more realistically, you can see the effect on the oil price of the damage to the global economy that we're seeing at the moment. So this is the short-term, one of the short-term deflationary impacts that we're seeing at the moment, falling oil and commodity prices. And the next one, if we can pull up the next slide, well, what this shows is that is US unemployment, the US unemployment rate, and the abrupt shift from a very low unemployment rate, a similar unemployment rate to the one we had in the UK, 4% or below at the start of the year, and the spectacular increase in unemployment that we saw announced just very recently. So the unemployment rate has essentially gone from below 4% to nearly 15% in the space of a month, and nothing like this in terms of the immediate response to a downturn has been seen before. I mean, this just demonstrates perfectly what happens when you lock down economies, when you stop normal economic activity happening by government decree. People don't have jobs to go to. You can try and preserve them in those jobs, as the UK government is trying to do through its job retention scheme. But essentially, the result is a big increase in unemployment, and what that means is that there is then spare capacity in the economy. There are people who are not working. Unemployment is one of those definitions of spare capacity, of there being, in the jargon, a large output gap, and a large output gap is in general associated with falling, not rising inflation. So I think we've got this conundrum at the moment, which is that in the short term, and I'm talking about the next 12 months, it is more likely that inflation will be falling rather than rising. But if we can move on to what I think we're talking about mainly here today, what is the effect of, and we move on to the next one, that's just the unemployment rate again. What we're also seeing, as I mentioned, is, and this chart here doesn't reflect the full extent to which the world's central banks have embarked on aggressive QE programs in response to the crisis. And you will remember that people who follow these things, and even people who don't follow these things, they often say to me, what is this, just printing money? What's the aim of this? And what kept QE programs honest was always the promise that at the end of it, you would be able to, they are asset purchase programs. So central banks create money electronically to buy assets in the markets. Most of those assets are government bonds, but not all of them. And the promise was that at the end of it, you would be able to wind it back, return to where you started by selling those assets back, or by, as the Federal Reserve tried to do, by not reinvesting the proceeds of maturing assets. Now, even before the coronavirus crisis, central banks had stopped trying to unwind QE. So the Federal Reserve tried it for a while and then stopped when the economy slowed, even in anticipation of this crisis. So what you've got there is a further big buildup of central bank balance sheets, of central banks creating money, and not on top of the fact that none of it has been wound down to speak of since the financial crisis and the rounds of QE that we've had since the crisis. So the central bank balance sheets have expanded hugely, with no sign that they're going to be wound back at any time. So this is a concern. It's, you know, and some people would say it is monetary financing until you wind back, until you reduce the size of those balance sheets. So that is a concern. And another concern is the fact that, if we can have the next slide, that this doesn't fully capture what is happening, but what we are seeing is a rise in money supply, particularly in the US, but also in other countries. And you know, since this slide was produced by the Institute for International Monetary Research at Buckingham, which is Professor Tim Congdon's research body, and he's been a monetarist since the 1970s. Money supply has expanded further, and the concern here is that what we're seeing is, as you say, a lot of monetary growth. Now, you know, people listening to this may say, well, didn't we have all this 10 years ago when central banks launched their QE programs? Weren't there a lot of worries about inflation then? And some people did worry about it, but people like Tim Congdon didn't, because he recognized that such was the damage to the banking system that the money supply growth that was being artificially generated, if you like, by central banks there was not going to be inflationary, and it wasn't inflationary. This time he is worried. And the message to me is, and I'm very interested in what Luka's got to say on this, is that short-term inflation is not a worry. Medium-term, it could be, particularly if central banks find it difficult to unwind the emergency measures, the ultra-low interest rates, lowest interest rates we've ever seen, that they have adopted in response to it. So I think some of the concern about inflation is genuine, and I think will have to be addressed if it's not going to become a serious problem in 2 or 3 years' time.
David, thank you very much for that. That's a very good introduction there. Let's turn now to Luka. Ruffer, your firm have been inflation hawks, if I can put it that way, or you've talked about the possibility of inflation for a long time. And the way that money's been invested with Ruffer has really had that in the back of your minds. Also, you've been preparing for a market crash, and you've done quite well in the last few months. We'll possibly come back to that in a bit. But first of all, can you just talk a bit about your own experience with inflation? Because I know you've got your own personal story. And then also go on just to expound upon your concerns about the amount of money being injected into the system at the moment. Luka.
Yes, of course. And thank you, Nicholas, for the introduction. So I think that there were probably 2 reasons Nicholas felt compelled to invite me to this talk. The first, as he's mentioned, is that I'm a rare citizen of a developed economy who has lived through a major inflation, and my family indeed lost the little that it had in the Yugoslav hyperinflation in the early 90s. And even though I was a child, you know, I was raised in the circumstances and lived through the endless discussions of the whys and wherefores of that. And perhaps Isabel could bring up the slide showing the banknote that culminated, that was the kind of the end of the Yugoslav hyperinflation. And there it is there, the 500 billion dinar note, which was worth about $1 at issue.
And what was the price of a cabbage?
Yeah, more or less the price of a cabbage, as my dad reported in real time in late 1993 when it was issued. Secondly, Nicholas mentioned Ruffer. I won't dwell on this too much. we're an investment manager based in the UK that looks after £20 billion of people's savings. People calling in from Australia may be interested that we've been managing investments there as well for over a decade with the likes of MLC Investments and Together Asset Management. And we make it our business to generate positive returns, whatever the market is doing. And I'd asked Isabel to move to the next slide to illustrate what I mean by this. And we have indeed managed to preserve capital through the dot-com bust, through the financial crisis, and as Nicholas mentioned, are in positive territory for so far in 2020. Now, since QE was first launched in America in early 2009, and I should say since it was first launched in America, it was previously tried in Japan and elsewhere. But since 2009, we've been preoccupied with protecting clients from what we think is a financial repression, and I'll go on to talk about that in a bit, which we think may well at some point also include significant inflation. And I'm afraid we didn't listen to the esteemed Professor Congdon in 2009. We did worry that the interventions launched by the central banks then would result in higher inflation, and we've spent the last 10 years getting progressively more concerned, despite not on the face of it being right. So what I'm going to do through the next 5 minutes is just draw a couple of parallels from the Yugoslav experience that I think are relevant to today's situation, and why I would strongly agree with David's conclusion that the kind of medium to long-term outlook for inflation in the UK and indeed the US and possibly even Europe is positive and a cause for concern. So if we go to the next slide, I'm going to spend 30 seconds on this. Tens of thousands of pages of books have been written by much better men and women than me. So here we go. Yugoslavia is the pink blob on the left-hand map, and after the Second World War, it was in a strategically important position. It was keeping the Eastern Bloc out of the Mediterranean. That gave Yugoslavia, gave Tito an easy flow of dollar funding, and that was used to kind of boost the economy. Now, holding together a federation is a difficult thing, and the map on the right-hand side shows the republics that constituted the federation of Yugoslavia. And essentially what he had to do was spend ever more money to keep the people in those republics happy. Some of the investment was productive, a lot of it wasn't, so they needed to accumulate ever more debt to sustain a similar level of growth and to keep the country together. And then essentially when he died, it was time to pay back those debts, and there was no way of doing it aside from to start printing Yugoslav dinars in ever larger quantities. That had the effect of devaluing the dinar, increasing inflation locally, and whilst they did try and reform internally as well, tried privatization and various other measures, it was ultimately the path of least resistance to print dinars to service the debt. So I'll sort of leave you with that idea. I think the strongest parallel between that little anecdote and what's happening today is just to remember that where we have federations and quasi-federations such as the UK, the EU, and indeed the US, politically the path of least resistance is to print money rather than tackle the difficult business of structural reform. And I think this is one of the things that, in all of the numbers and all of the data that gets churned out, especially at economically exciting, albeit socially devastating times like this, it's easy to forget that inflation is as much a social and political phenomenon as it is a financial and economic one. So that's the big lesson from our experience. I think if we move on to the next slide, what's the backdrop? So at a very high level, what we have seen over the last 10 and indeed 30 really years has been a large increase in the amount of debt in the world, both at the governmental level and the corporate and indeed the household level. This hasn't spared fiscally prudent countries either, with the pretty much lone exception of Germany. And I think I would make a strong argument that if there was less debt now, COVID would still be a human tragedy, but we would all be feeling a lot better about how we were going to pay for it all. And we wouldn't be having these discussions about the potentially coming inflation, the monetary instability that we're having now. And what this chart simply shows is really that nothing was learnt from the crisis of 2008. And despite debt being an acknowledged cause of the troubles in the global financial crisis, the world responded by just leveraging up even further. And I would say that this chart will look even more ugly, and the bars will be much higher when it's run for the end of 2020. So that's our backdrop. And now, how do we get out of this? And I'd ask us to move to the next slide. And I make no apology for the simplicity of this. There are really only 5 options. Real growth involves investment in things that are productive, that increase the productive capacity of an economy over time. And frankly, we haven't seen that in the biggest economies in the world for many years, for decades. And there are many reasons for that, which is a whole separate debate in and of itself, but it's been very hard to achieve, and we'll just take that as a fact. Fiscal austerity, I would say we've had half-hearted attempts at it, which is an unkind thing to say, if you're in the unfortunate position of having suffered from that austerity. But in truth, throughout all of the austerity that we've seen in the UK and in Europe, and to some extent in the US, the governmental debt burden was rising, the corporate debt burden has been rising. So it hasn't been an effective way of reducing the debt. Restructuring or default are so unattractive that any serious government that has the ability to print its own currency will never consider them an option. So the UK famously has never missed an interest payment, and that's simply because it's had the ability to print sterling and make good on coupons whenever it's needed to. So I think we can discount all 3 of the above as options, which leaves us with the lower 2. A sudden burst of surprise inflation, or a long period of low-level financial repression. Now, what these options are essentially is inflation slowly or quickly, inflation low or high. What we've lived through in the last 10 years has been a low-level financial repression. We have had interest rates held persistently below inflation. Now, just to illustrate what this means by way of an analogy, it's what the government is essentially attempting to do when it engages in this policy is, if one thinks of the government debt as a mortgage and the tax receipts as one's income, you've got a mortgage at a fixed rate and you have an income that rises strongly with inflation. So over time, the burden of your mortgage becomes less and less of a big deal. Your income's rising so strongly. And this is the trick that's being attempted by all of the world's central banks. They're trying to make the government debt serviceable and sustainable and erode it slowly away. And so far, it's been very successful. The issue is that when you get to the lower bound of interest rates, you have to do ever more wacky things with monetary policy to keep the interest rate below the rate of inflation. And the danger is that the more wacky things you do with monetary policy, the bigger a risk of eventual inflation you're embedding. And again, I'll go on to talk about that in a second. So if you go to the next slide, what this just shows is that I'm not just making this up, it's a tried and tested way out of debt-induced pickles. Now, I have been struck by the number of charts that I've been sent that compare various economic impacts of the response to COVID to the experience of the last two wars. But what I haven't seen much of is really this chart, which shows that in all those cases, one of the other things that happened as economies kind of cleared and emerged from those crises was a period of currency devaluation and inflation. And I think this chart just demonstrates that governments will choose inflation over hard default. It's a great bit of analysis done by Reinhardt and Rogoff, and loses nothing for its age. So for us, Ruffer, the question it really is, what will be the path of this gap between the inflation rate and the interest rate? And I'd ask us to move to the next slide. So, and that's what we mean by real yield is the yield after inflation. Now, what this chart shows is in the green line just an attempt to calculate a straight real yield in the UK on a three-year average of inflation. So you know, what do you get if you hold cash on deposit after inflation? And the blue line shows the price of the longest dated UK inflation-linked bonds, again in real terms. Now, when the lines are below 0%, you are in this region of financial repression. You are in a place where inflation is eroding the value of your savings. And our strong contention is that given the starting point of these high debt burdens, and then added to them the populist politics that we're seeing, combined with a starting point where interest rates are already zero, you know, that sort of unholy trinity of factors means that people should take inflation risk a lot more seriously than they have done for a generation. And so when we think about the potential paths of that blue line out into the future, we think there is a bigger risk of it going strongly down the page than there is of it going back above 0%. And it's that asymmetry that of potential outcomes we think that means you really have to worry about inflation now. And I think I'll probably stop there, Nicholas, and open it up for discussion.
Thank you very much, Luka. That's really sort of comprehensive overview. Thank you. That was brilliant. I want to encourage everyone to look at the bottom of their screen, and you'll see that there's a Q&A sign there. So more questions will be coming through. So please do add more questions there, and we'll come to those very shortly. I'm going to come back to David to get his reaction. I think it's fair to say there have been sort of key things that have kept inflation down: global supply chains. We look at technology as well. Those things have helped to keep prices down. but you could also say that those two things are under threat at the same time that governments are printing money. So that might point towards inflation. Anyway, David, your thoughts on what's just been said, and then what I've just said then.
Yeah, I know. I think what Luka said was most interesting, and I was looking we don't overdo the wartime comparisons, but I was looking the other day at what happened to the UK after the Second World War, and we emerged from the Second World War with government debt at 270% of GDP, highest ever. Within 30 years, it was down to below 50% of GDP. Now, how was that brought about? It was brought about by a combination of four of the five things on Luka's chart. So the 1950s and 1960s were a good period for real growth, the golden age of the world economy. There was some inflation. There was certainly financial repression. And I think the interesting question now is whether you can replicate that in future. Now, if you've got, businesses like Ruffer trying to, show clients how to avoid getting caught in the investment trap of financial repression, then it becomes more difficult. In the period from 1945 onwards, a lot of UK financial institutions were almost obliged to buy government debt, to buy gilts, because of exchange controls and other restrictions on investment. So for their portfolios, even though the returns on government bonds were lousy, they had to buy them. So things are different now. Investment institutions are much freer. So I think it's very interesting. We're in I think central banks are there as support, but central banks can't do QE forever. I think governments, and we saw this from the British government before this crisis hit, have made the assumption that low yields are going to be around forever. So it's safe to borrow. And that's not the case. History tells us that that's not the case. But on your point, I think it's a very good point that you can see that in addition to the monetary things we've spoken about, the massive expansion of government spending programs, the QE to accompany it, you come out of this and the return to normality will be one in which global supply chains are quite seriously damaged. And, a lot of businesses are considering whether they can still source from China, whether if you remember, the initial impact of the coronavirus crisis was that businesses thousands of miles away from China had to close operations because they weren't getting the components through from Chinese factories. So I think that was one lesson that will be learned. Supply chains will be restricted. International trade is going to be severely restricted. It was already restricted by protectionism. It will now be restricted by limits on international travel, which of course, if you limit air travel, you also limit a lot of international trade. A lot of international trade is conducted through passenger air travel, the cargo holds in planes and so on. So it's not always cargo planes that transport into the goods and so on. So I think there is an additional danger there, which is that when economies switch back on, they will find that supply chains are not as efficient as they were. A lot of businesses will abandon just-in-time production, so that means an additional cost. There will be an additional cost for as long as social distancing has to remain in place, because it will mean much less efficient use of resources like offices and factories and so on. So I think those are an additional danger, which will have to be monitored very, very closely. And as we move into next year and hopefully a recovery phase from this, there is a real risk that is an additional inflationary danger.
Right, we've got some very good questions coming in now. In a second, I'll go to Graham Fry, if we can take Graham Fry's microphone. It's true to say, David, I think, and maybe Luke could comment as well in a second, and that a lot of economic theory or central banking theories, whether it's inflation, have been sort of turned on their head. Even as Claudio Borio has been talking about banks pursuing inflation and focusing on inflation at 2%. and they should be looking at other targets. And then also, and I think Graham's going to ask about modern monetary theory, which completely turns the way debt is assessed on its head as well. So Graham, you ask your question.
Morning, gentlemen. Yeah, my question was, there's been a lot of debate or a lot of ink spilled over the last few weeks about modern monetary theory, about the idea that sovereign governments can just print away without any real effect, which seems to go absolutely contra to everything we've been taught and everything we've just been discussing this morning. So I wondered what your thoughts were about that.
Well, let's get Luka on that one first. Let's try and be brief so we can rattle through these ones if possible, because I know we could talk for a very long time about monetary theory. Luka, good thing, bad thing, modern monetary theory. What is it roughly?
It's a school of thought about money that says, look, a government balance sheet. Governments don't have to balance their books in the way that households do. They are an unusual financial actor. They control the currency. If they need to spend on something, they should just print the currency and spend it on the good or the service that they think is appropriate. And yes, it runs some risk of fueling inflationary pressure, but you don't need to bother with all this borrowing. So why is it any worse than that? It is, and you know, the proponents might point to a country such as Japan, which is probably the closest to monetary financing, in the sense that, you know, the central bank owns the vast majority of the government bond market, so most of the new money kind of used by the Japanese government is just printed by the Bank of Japan and then sent to the Ministry of Finance. And they say, look, it's been going on there, it hasn't caused inflation, we should just get on with it and do it elsewhere. The issue is that in expanding the money supply permanently, you're doing away with even the illusion that there will ever be a balance. And so you should expect inflation expectations to rise permanently and more sustainably if you do that. So I think the idea that it can be followed with no inflationary consequences is misguided. And I'm strongly convinced of that in the UK and in Europe. The US is a more complicated and interesting case, because one could make the argument that if there is a lot of demand externally for the currency being printed, then you might be able to get away with it. And the US dollar, being the reserve currency still of the world, you know, may just be a way through. I think for anyone looking to read more on this, I would highly recommend anything written by Stephanie Kelton, including, if I may plug an article in the Ruffer Review, which can be found on Ruffer's website. And she really is a very clear proponent and a powerful one of this theory. But I ultimately, I think it's not a good thing. It promises more than it can deliver.
David.
Yeah, I'm a complete MMT skeptic. That MMT, modern monetary theory, MMT also stands for magic money tree, and I think it is very much in that area. And I think Luka's own experience, where of what happens when you print money, and you know, there is a limit to what governments can do. And I think MMT protagonists always look at this in terms of, you know, why do you need austerity? Why do you, you know, why can't governments spend? Who can print their own money? Why can't they spend freely? Well, if you take it to its logical conclusion, why do you need taxation? You know, why can't you just print and print until you get inflation? I think it's dangerous. I think it's misguided. I don't think, and I think one reassuring thing is that there is no sign of governments or central banks in any country I can think of being remotely tempted by this. The Japanese case is interesting, but what you have in Japan, very high level of government debt to GDP, but also a very small proportion of Japanese government bonds which are foreign owned. There is a big domestic appetite, apart from the central bank, for Japanese government bonds. I don't think it presents any kind of model for anywhere else. And I think the fact that had Bernie Sanders been the Democratic nominee for the presidential election, I think the MMT protagonists in America would have a better chance of seeing something like that emerge. With Joe Biden, there is zero chance of that. So it's an interesting discussion, but I don't think it's going to go anywhere.
I did note Mario Draghi said it was worth looking at MMT just before he left his job. So that's
as long as you look at it and reject it, I think.
Hilary Matthews, can we bring Hilary Matthews online as well? Hilary, can you hear us? Hilary, you should be able to hear us now. If you've got there you go, Hilary. Go on.
Can you hear me?
Yes, yeah.
Hello. Yes, I just was reading in the paper the other day that Mervyn King, in fact, I heard him on the radio this morning, thinks that the current governor's optimism that the economy will recover very quickly is misjudged, talking about this V-shaped recovery, and that it will take much longer. My simple question is, and I am not an economist, and I'm very, very much an amateur of interested listener, is which of them is right, Andrew Bailey or Mervyn King?
This is obviously crucial in terms of the debt accumulation and then possibly the impact on inflation later. Let's try and answer these things fairly quickly because we've got a lot of questions to go. So briefly, Mervyn King, right, or the current governor, Luka?
I'm afraid I'm with Mervyn King on this one. The bank and the government are doing a great job of keeping confidence intact, but time is not on their side, and it will take a year of disruption to normal economic practices at least to get through this. And the longer that happens, the more the nasty knock-on effects will drag on growth. And so we're not going to get the big bounce back that Mr.
David, Luca's right. There's a lot of capacity in the economy is just being knocked out, isn't it?
It is, but I'm just writing a piece for the Times for tomorrow on this, and just to give you a sneak preview, in economic terms, in GDP terms, this will most definitely be a V-shaped recession and recovery. They always are, So, and you can explain that quite simply. That the low point of this recession is the second quarter. We've probably passed it by now. GDP in the third quarter will be higher than it was in the second quarter because lockdown restrictions will be eased, and higher again in the fourth quarter. You will get a V. The difference is that for a lot of businesses, in the labour market, it will not feel like that. So we'll look back in 10 years' time. We'll see, as it happened in 2008-9, as happened in the early 90s, a nice V shape. But people will say, as they did then, that this dragged on for years and years in the housing market, in the labour market, and so on. So for a purist economist view, it's V-shaped. For the way it feels to businesses, the way it feels to people who are made unemployed, it will feel anything but. So I think that's the distinction one should draw.
Right. That makes everyone love economists, I guess. I'd like to go to Annie, Simon Jackson, and it's actually Annie who's going to be talking. Annie's disguised with a beard when she comes up. So if we can bring Annie's microphone on, that would be great, in the form of Simon Jackson. Annie, can you hear us? I think you can, yeah.
I can indeed. Do you have any views on the reliability or accuracy, I don't know which term if I'm looking for, of inflation data, both the wholesale and consumer price indices, when looking at this question about how inflation compares to nominal interest rates?
Okay, Luka quickly, and then David.
Yeah, great question. And you know, in the UK's case, I think it's something like 40% of the RPI basket requires someone physically to go into a shop and measure a price, which obviously currently is impossible. So there is actually it's a very valid question. I don't think we've got very good answers. One thing you can guarantee is that the inflation data, the official government inflation data, will not be reliable, in the sense that it's in the government's own interest to keep the numbers low. You know, they have obligations, pension and otherwise, that are linked to inflation, and they do not benefit much from those inflation readings being very high. So you do have a slight disconnect between published inflation and then the inflation felt by people who actually, you know, find that the goods and services they use most regularly are rising in price much faster. It's one of the things that actually makes protecting from inflation for savers that much harder. But yeah.
David.
Yeah, I mean, on the short-term point, I did talk to the Office for National Statistics about this, and the question I had was, do the price collectors have to queue like the rest of us before they can get into the supermarket? And the answer is no. They ring up the store, and rather than going around with the aisles with a pen and paper, they get the prices directly. As they are getting the prices directly from other stores, and of course most of those are online prices. So I think there will be some damage to the short-term inflation measurement, but not long-term. But I suspect the questioner may be thinking of exercises like shadow stats in the US, which say that there has been a long-term underestimate of inflation. If you'd used previous weightings, you would have much higher inflation. And I think there is something in that. I mean, one thing I've learned from experience is that nobody is ever happy with inflation measurement. The vast majority of people who email me about inflation say that inflation understates, the inflation measure understates their own inflation experience. And there is a simple reason for that. And the simple reason for that is that people notice when prices go up. They don't notice much when prices are stable or falling. Nobody has in their own mind a perfectly weighted inflation basket that they monitor on a monthly basis. So I think the inflation figure, and of course in this country we've had a big debate about the switch from the retail prices index to the consumer prices index. I think the statisticians do a reasonable job. I don't think there is a persistent understatement of inflation.
We've got some good questions coming here. Please, can you stay on the line after the hour? Because I think a lot of you have got some really interesting views and a lot of relevant experience from different jobs, different markets, which I think will add to the conversation. So do stay on at 10 o'clock. You can raise your hand, or you just stay online, and we'll come to you then. Another question that follows off the back of the one we've been talking about just now is from David Cresswell Perry. If we can come to David in a second, and then to Mari Grosswent in Hawaii. So let's take David first. David, ask your question.
Yeah, well, I come from a totally different background, advertising and psychology, and we've always been led to believe that the central banks, the Fed and so forth, Bank of England, Bank of Japan, are the ones that control the economy on our behalf. I have a feeling, and a very strong one, that on this occasion, this generation, all of us here on the planet, have been hit with a double whammy twice now in 12 years. Never happened before in any previous generation in recent times. And I think that this hit to the grey matter that is concerned with shopping, discretionary spending, could have a very lasting effect, and indeed possibly a permanent change, if you like, a paradigm shift in the way we go about our discretionary spending, way after we've got past, and hopefully a vaccine, and we're all relatively safe to go out. So my question really is exactly that. Do you think that the consumer this time around is the one who's going to be in the driving seat?
David.
I think that's a very good question. And what people say to me, you know, what is the longer term behavioral response to this. Do we go back to eating out in close proximity in restaurants? Do we go back to pubs? Do we go back to the kind of experience-driven consumerism that we've had over the past 10 years? And I suspect that won't be the case. I think we'll find, certainly in the case of the UK and the US, you write off the consumer at your peril. These are economies which are driven by low savings rates and quite high consumer spending, and I think that will resume after this crisis is over. I don't think we're suddenly going to become, much more prudent in terms of precautionary savings because of this episode. But within consumer spending, people will change quite a lot. I think there are certain things, certain industries you would not want to be in at the moment. The airline industry, I think it's going to be quite some time, even longer than after 9/11, before people are very comfortable with flying. I think foreign holidays are going to be, that's going to be a different kind of consumption decision. So I think consumer spending will come back, but I think within that, and obviously that's of tremendous concern for the businesses involved, there are going to be big changes in the composition of consumer spending.
Luka, do you want to come address that briefly as well?
Yes, I think it's too early to say, frankly. To put the other side to David's argument, you could point to the Japanese experience after the late 80s, where again you had a crash and you had a backdrop of high debt, and they kind of the population experienced a kind of near death financial experience, and
lived through that.
As a result, on the whole, stopped spending, consumed less, and started saving. I don't expect for a second the results here to be as dramatic as that, but I think it will make a lot of people think twice about building up a bit of a financial buffer, and that in itself will act as a bit of a brake on the resumption of consumption at the levels we saw going into the virus.
Okay, Margie in Hawaii, you've got your question. Margie, I think we can hear you.
Okay. I'm a real estate broker with over 40 years of experience in real estate, and in the early 1980s, before globalization and before technology growth, we experienced high inflation, and our mortgage rates in the US between 1981 and 1986 were in the range of 14 to 20%. Right now, our mortgage rates are 3%, and we have a robust market, I would say below $1.2 million, which feels very inflationary to me, as though people are grabbing assets like real estate because they can anchor debt at such an incredibly low rate. I'm curious, my question is, do you see any parallels to today's environment to the early 1980s, or are we just in a brave new world with different circumstances altogether?
Maybe I could put could you make predictions on inflation, possibly, Luka? I mean, some people are talking about 5% as an acceptable level in the States. Could we get up to the teens, Luka, and then David again off the back of that, Luka?
We think actually in the short term inflation will go down. I think in as measured, as David suggested at the beginning of the talk. Going into next year, we would not be surprised if by the end of next year we had a situation like we had around at the end of 2010 and going into 2011, where you had the combination of supply and demand shocks resulting in higher inflation, and in that case, it did indeed nudge up to 5%, and the interest rate was kept at zero. We suspect something similar will happen again, and then the crucial question is that happening at a time of economic recovery, or is it happening in something more like a sort of stagflation, which is ultimately what led to the conditions that Margie's describing in the early 80s.
David, what are your feelings?
Well, it's a very good question from Margie. I think if you listen to people like Tim Congdon, who I referred to earlier, he does expect UK inflation to get to and US inflation to get towards double figures, if not into double figures, if action is not taken. And I think action probably will have to be taken. I think the key thing, as I suggested earlier, I mean, the situation that Margie described was the American version of the monetarist experiment under Paul Volcker, where interest rates were put up to very high levels to kill inflation once and for all. And that came after, the two oil crises of the mid and late 70s, and inflation rates in many countries there went very high. The UK had an inflation rate of more than 20% in that period. So there was a determination to kill it off and to get the money supply under control. Now, we're not in that situation now, but we are in a situation where official interest rates are unsustainably low. You can't keep official interest rates close to zero. The average for UK official interest rates in the 1980s was 12%. The average in the period leading up to the financial crisis was 5%. It was the ambition of the central bank, the Bank of England, to get back to something like 2 to 3%. And now we're at 0.1%. So that is not sustainable. I think the one thing I would want to see, and I think would expect to see, is that there will be a quicker response to normalize interest rates this time than there was after the financial crisis. But normalizing interest rates doesn't mean going back to 17 or 18%. It does mean going back to 2 or 3% as an initial staging post. And then we'll see where we are in terms of whether that controls the money supply, keeps inflation close to official central bank targets. I mean, one thing we haven't discussed, I don't stop anybody else asking a question, is the point that Luka made, which is, do governments actually want financial repression through higher inflation? And are they prepared to override their central banks in order to do that? And we've obviously seen a big battle in America between the White House and the Federal Reserve. Could that be replicated elsewhere? I think that's going to be one of the interesting debates and questions for the next few years.
I might just jump in quickly at that point, David, if I may, which is to say I think what the Rubicon that's now been crossed is that central banks and governments really are complicit in this together. It's a cooperative effort, and I think any to the extent that central banks are objecting to the policies they're putting in place now, really that it's lip service. I think what the central bankers have long been after is more concerted action fiscally to address the debts. Be that through investment and more fiscal expenditure to boost productivity and boost growth. I think they're both agreed on the fact that monetary policy has to stay extraordinarily easy. Again, I think dangerously people will point to the fact that Japan had near zero interest rates for over 20 years with no disastrous effects, and we'll use that as cover to do the same in the US and the UK. So I'm less sort of constructive on that part of interest rates, and I'm more cynical about the cooperation between central banks and governments from here.
Well, we've only got just over a minute left. There's a spanner in the works being thrown by Paul Jackson. I'm going to ask his question for him. So 20 seconds from both of you. New debt crisis. Will the euro survive? Very briefly. David.
Yes, the euro will survive. I think the euro survived its most difficult moment, which is the eurozone crisis of a few years ago. And despite the German Constitutional Court, despite everything else, I think the euro has quite a lot of resilience. I think it will survive.
Luka, you've got even less time. Go on.
Yes, it will survive. The big issue for the Eurozone will be inflation, and currently they're battling deflation. And whilst that's the case, the euro will be fine. Once they have to grapple with higher inflation in the Eurozone, then they're in trouble.
Okay, there's one question that's just come up from Stuart Williams, which I will ask as well, and we're running slightly over time, but I'll ask it anyway. If interest rates rise, will UK house prices crash? Will that lead to mass bankruptcies or a debt jubilee? David.
I think the UK house prices have been supported by very low interest rates, and they've also been supported by the strength of employment. Now, employment's going to fall quite a lot, so that will remove one pillar from the UK housing market. If and when interest rates go up, that will remove another. So I think UK house prices are going to fall this year because of the lockdown, because of the recession. I don't think it's going to be a house price crash of the sort we saw in the early 90s, but I think it's going to be quite a long time before we see robust growth in house prices again from the lower levels that we see this year.
Well, thank you both very much. It's been a wonderful briefing and overview, but I want to say thank you very much to David Smith from the Sunday Times and Luka Gakic from Ruffer. Next week, I'll be speaking with a Korean refugee and defector, Yoon Hee Park, who's got a remarkable story to tell, so do join me then.